Ladies and gentlemen, welcome to the Creating Tailwinds podcast by FlightPath Financial. This is January 31st, 2025. I am John Urbik, the CEO of FlightPath Financial, and I'm here with my co-host, Jared Adams. We'll be talking about all things infinite banking with a special emphasis on infinite banking for pilots, bringing our unique insights into the challenges professional airline pilots contend with. Both Jared and I are highly experienced professional airline pilots. Jared comes to us with a wealth of experience from the civilian world, and I come from a military background. And we look forward to presenting the very compelling arguments that you'll discover when you learn more about infinite banking. And we thought we'd start this episode by talking about the Bible of infinite banking, Becoming Your Own Banker, by R. Nelson Nash, who was arguably the godfather of the infinite banking concept. We strongly encourage anyone who is interested in this to read the book, Becoming Your Own Banker. 5th edition was put out in the year 2000. You can get it at our website at flightpathfinancial.com. You can get it at infinitebanking.org. You can call us and we can mail it to you, Pony Express. But I'm going to toss it over to Jared and let Jared talk a little bit about himself, and then we'll dive right into the book.
Thanks, John. I appreciate that intro. Thanks to anybody who's tuning in. It's a pleasure and an awesome opportunity to be able to just talk about something that's really a passion of ours. You know, this has become near and dear to our heart. It's something that we caught, that we understand so much that we can't wait to share with those who are willing and want to learn about the infinite banking concept. As John said, my name is Jared Adams. I grew up south of Buffalo, New York. I currently live in the Atlanta area with 3 daughters. So you can imagine the schedule is quite crazy, chasing around for basketball and softball and all those things that the 7 through 11-year-olds are going to get into. So life is busy, but that doesn't stop our need for finance. We are constantly looking as aviators, we're constantly looking to make sure that our money is going into the right place, the right investments, the right warehouse. And John and I wanted to kick off the podcast topic here by, just as John said, talking about Becoming Your Own Banker, the Infinite Banking Concept, the book by R. Nelson Nash. We thought it might be prudent to just dive through a couple of the topics that show up throughout the book and just kind of introduce these topics more so as a teaser. We really want you to get back out and go do some of your own research and read this book on your own. And then we'd love to rough the edges and even smooth those edges a little bit further as that becomes available, as you begin to understand this IBC or infinite banking concept. John, that's just a quick intro background on me. What would you like to share about yourself?
I grew up in Chicago. I'm married with my wife and 5 grown children who've all done very well. They're all very schooled in the infinite banking concept. And I've been, as you also are, a professional airline pilot. Flew in the military for almost 13 years, a couple tours of combat, and have flown just about everything out there in the inventory at the major airlines fly as an instructor. But I've come full circle. We met through our common channels and discovered that we had an affinity toward the same thing, infinite banking, and why it makes sense and why it's so different than everything else that's out there. And more importantly, there are pilots in particular who are tracking a conventional pathway toward retirement who know nothing about this. And we're going to try to fix that. And you can draw your own conclusions, but we're going to arm you with the facts. We are a warehouse of NOTAMs, and you can pick the field you want to fly to.
That's right. John Nelson said he wanted to create the 10%.
Yes.
Right? So he that was a big passion for his, that he knew not everyone would understand this concept or grasp, what the ideas are behind here. Well, build on that a little bit. What would you think about building the 10%? What does that mean to you?
Yeah, the 10% basically is a psychological phenomena that if you get 10% of a group to move in one direction, the other 90% seem to follow. And so what Jared and I are doing is we are trying to build the 10%. That was Nelson's mission in life, is to show people that they could build their own personal economic model, that they didn't have to succumb to every whim and change that came down from Washington or elsewhere, that they could build a warehouse of wealth, and they could very efficiently handle their money in a way that they chose and build the futures that they desired. It's a phenomenal approach, and Jared and I are going to share that with you.
Yeah, I think that's such a great description of that, John. It's amazing how if you were to grab a bunch of 20-year-olds right now, even in the early 2020s, and you just sat them at a corner, they're just starting to make a little income, and you said, well, what, you got a little extra income on the side, what are you going to do with that? And every single one of them is likely to say, well, we're going to put it in the highest yield savings account that we can find. And it's just amazing how quick, we would have saw that in our young days, or whether it was 10 years ago, 3 years ago, or 30 years ago, when a little bit extra started to come in. What did you do with it? How did you manage it? Did you put it in a spot that it growed? Did it grow tax-free, tax-deferred? What did that look like? So just kind of an amazing concept that you just jump in line and do what everybody else is doing. And I think that's a perfect description of that 10%. So we're going to invite you to maybe step outside your comfort zone and step outside your bounds a little bit and just think about something a little bit differently. Some of Nelson Nash's teachings are just amazing in what they can do and teach on how you can control your capital. One of the things that he talks about in the very beginning of his book is how there's really only one pool of money out there. John, what would you describe that as? How do you view that there's only one pool of money?
Well, Jared, quite simply, we live in an interrelated world. Our economies, our banking systems are all combined. They're mixed together. So it really doesn't matter if you're dealing in dollars, euros, drachma, renminbi, any currency that you can imagine. There is an exchange out there through the common portals of finance to change from one currency to the other. Whatever happens in one area ultimately flows into another. Nelson talks about how water flows, whether it's in the Indian Ocean or in the Pacific Ocean. That water will find its way up into the sky, make a full circle through evaporation and rainfall down in another part of the world. We all are impacted by the flow of money. And our endeavor here is to show you that, look, we're all in this together, and money must flow. And if it must flow, why not put yourself between your money and where it flows, because that's where you're going to benefit the greatest.
I think that's a great description, John. One of the other things that he talks about is just kind of where it started, how Nelson kind of stumbled upon the infinite banking concept. I say stumbled. Is that an accurate description? You knew Nelson personally.
Yeah.
Would you agree that he just kind of stumbled on it?
Well, if you read his book, and I know you've had many times, Jared, Nelson, by training, was a forester, and he got into real estate early on, and he had great visions of how much money he was going to make, and he made quite a bit of money in the timber business. But then interest rates went up, and his notes were called, and suddenly he's forced to pay a much, much higher interest rate, not much unlike the environment we're in today. We think we're paying a lower interest rate, and we plan on that, and then all of a sudden the interest rates double and triple, or in Nelson's case, quadruple from there. And now he's got this massive debt load that he's got to cover. So his story goes into how he bailed out of that, and he was on his knees trying to figure out what in the world is he going to do, and he discovered it sat right there in front of him inside of his life insurance contract. There were cash value there. And he could lever that cash value into these expenses, do a debt rotation, and then ultimately pay all those expenses off. And it was a beautiful thing, and it works. And both Jared and I and our clients use this.
That's a perfect description. I think the number that he ended up getting to that he quotes in the book is he had about $500,000 that he owed at a 23% interest rate.
Yeah.
Wow, the early 80s.
Could we see that again? Is that possible?
There's nothing that's out of the realm.
No, sir.
Good grief, I hope it doesn't get that high again.
I know.
But it is not out of bounds. He was saying that's $67,000 just in interest payments.
Yes.
Wow.
We pay so much interest, Jared. People don't realize. Just take where interest rates are like 7% right now on a 30-year mortgage, and people move. We have a very nomadic society. So say you live in a place for 5 years, you get a 30-year mortgage at 7%. Take a look at the amount of the volume of interest, not the interest rate, but the volume of interest. If you look at on a 7-year percent note over 5 years, you're paying about 86% of every dollar to that bank in interest. It's not 7%, 86%. Think about that. If there was a better way of doing that, would you want to look at it? How about even a down payment for a house? Saving it up inside of an infinite banking contract where you can get the money for 5 or 6%, and we can talk about that later, instead of 86%.
86% is crazy.
It is very
nobody
crazy.
Views it that way. Whenever they're talking about the 2.375 interest rate they got on their mortgage back when we had these crazy rates, they were, you saw that's a low rate. And I'm sure that the amount that they were paying in interest is less than the people are paying that are 7. But it's when you look at the actual volume, it can get really high numbers quick. I think what's the number Nelson uses as the amount of average interest the average American pays?
34%.
34%.
Yeah.
Yep. And that's just the amount that you're paying in volume of interest.
Exactly right.
Whether it's a note on your car, a mortgage, but anything you finance, we just talked about as the money flows, it has to flow through something. Every time you spend $1 on anything, you gave up that dollar for the product or service that you received. What was the cost of that dollar? If you would have kept that dollar and allowed someone else's borrowed money pay for that, could you have put your money to use? Could you have put it to work?
I can give you an example of that. Back a couple of Marches ago, we had a hailstorm here. My roof was totaled, it was pelted with hail, and we were actually getting leaks inside the house. There was damage being done inside. I was struggling with a property casualty company that didn't want to cover it, but I had to deal with that roof. And so I have a large roof. It was going to cost almost $30,000 to repair that roof because I needed a whole new roof. And I went to the roofing company, said, no problem, we'll give you the money. When I backed in the numbers from them, it was about 12% over a 4-year period to finance paying for that roof. I said, shoot, I've got the money sitting here in my infinite banking account. I'm going to use that at 5%. So think of the spread over 4 years between 12 and 5%. And I was getting a dividend on my money. That money, essentially, and this is something Jared and I can talk about later, but the net cost of that money was about zero for me. The net cost was about zero. So I paid for my roof at a 0% nearly rate instead of paying the bank 12%, and I kept my money.
Well, let me queue up a couple of the questions around that same topic that's likely going to get asked, right? Did you pay back the money that you borrowed from your infinite banking policy? How did that work? What did that look like?
Sure, and you want to pay the money back. It's a fluid instrument. It is not an investment, as some people would say. It is a warehouse of wealth. It's where you keep your capital. Not unlike having a bank account, which I tap, and once the money is spent, it's gone. The money that's inside my life insurance contract, my dividend-paying whole life insurance contract, when I borrowed that money, Jared, I was borrowing from the general funds of the life insurance company. Other people's money. My money never left my account. It continued to grow tax-free, uninterrupted tax-free money, which is so important to understand that concept. And I simply set up my own payback schedule with the insurance company. Yes, I paid it back, but I'm free to say I could either pay it all back next month, or maybe I have a job where money comes and goes in spurts, and I'm not going to see a chunk of change like that for 18 months. Fine. I just carry it in interest for 18 months, and when the money comes in with a stroke of a pen, boom, I cut the check, goes back to the life insurance company, and that debt is resolved. So the life insurance company gets their money back into their general funds to deploy to other investments for all the policyholders that own the company, and my money is available again through a collateralized loan for the next expense.
I think you described it perfect, and really where I was leading that question a little bit. You were playing honest banker. When you borrowed the money from the cash value of your whole life insurance policy, you set a payment plan of which you were going to pay back the money that you borrowed from that account. It was not set in stone. You were allowed to change the terms because as someone who controls your own capital, you're the one that sets the rules. So, it was a bit of a loaded question because I knew you handled it properly, but I think it's fair to emphasize that you were playing honest banker by making sure that you were going to only use the funds you were borrowing in a way that you could pay them back. And in a lot of ways that shows up as, even though you're borrowing money from the cash value of your account, go see what the current interest rate is. John said it was 12% to pay that back. Maybe you should pay yourself back at 12%. Go and see what it amortizes on your own calculator of 12% straight interest to pay that back in, let's say, 36 months. Whatever that monthly payment is, pay that back. Play honest banker. Maybe you get a windfall where you had a couple of really good months, or something else changed because there was a lot of extra flying, and then you stroke the check, like you said, to just write off that debt, to complete that debt. But at the end of the day, you were playing honest banker through the entire process. And that actually leads us to another good topic that starts off at the beginning of the book, where Nelson describes a grocery store.
Let me carry on one other point on that,
Yeah,
Jared.
sure. Go for it.
You want to have an amortization schedule that you built for yourself, but what if that money was from the bank? What if I borrowed that 30 grand from the First National Bank of Main Street? They're going to give me a statement. Every 30 days, I got to make a payment on that. If I went for that 18 months, I'm 90 days late. They're going to come after me. They're going to ding my credit rating, and I'm going to get all kinds of nasty grams from the bank that issued me the money. You do not have that with a life insurance company. They will send you a notice of amount due, but it doesn't have to be paid. It's paid on your terms. So long as the contract remains in force and is fully funded, meaning you're making your payments on your regular premiums, your annual premiums, you're good as gold.
That's right.
So
Yep.
Anyway, just want to make that clarification.
No, I think that's a great clarification, and that really hits on the point that this is the cash value is the equity of your death benefit, right? So
Exactly.
when you are setting the terms or changing the terms, it's because the participating whole life company that you're working with is saying the money that you've borrowed, that's covered. It's covered by your death benefit. We
Right.
know we're going to get that fund some way or another.
Right.
Whether it's because you've graduated or it's because you've put back the money into the policy, they're confident they're going to get their money back. So that's why they're able to let you be flexible with those terms. If you miss 2 or 3 payments, they don't come and repossess your car. Or
Right.
they don't put a lien on your home.
Yeah.
They know that it's going to be there to be able to recover the funds that you've borrowed from the cash value.
And it's guaranteed. You have guaranteed access to this money. If you go to a bank, they're going to throw you in front of their loan committee, and the loan committee can come back and say, no, we're not going to give it to you, or you're going to get an exorbitant interest rate because of a ding credit history. None of that with the life insurance contract.
Or the
exists.
privacy piece. They may go,
And
well,
it's
we
huge.
hear your wife works too. Could we see all of her W-2s?
Yes.
The where that goes and
Yeah.
how far that can go from that interview of the bank.
Exactly.
There's none of that with the cash value of your life insurance.
Yeah, I just did an article in LinkedIn on the difference between IBC and an offshore bank account, and I went through all of those variables that you were talking about. That you don't have to have an offshore bank account. You have it all the benefits of having an offshore bank account exist to the everybody, from the very well-heeled to the people who are of modest means, all inside of a life insurance contract.
Yep.
They can build it.
I think one of the main reasons that Nelson, this was such a passion for him, was that he wanted it to be known that you don't have to make $1 million
No.
to have an infinite banking contract. I mean, he goes through a description in the book that talks about somebody that made, take-home pay just short of $30,000 a year. How, what percentage went where and how he spent what, and how that could be formed into just using those funds to maybe loan his own car, so that he was the bank, he was the financier of his own vehicle, and how much windfall that created for him, and how that person had created their own tailwinds through that process.
Well, Jared, one of the items that is important, one of the concepts that's important for people to understand is the difference between uninterrupted and interrupted compounding interest. When you have a dividend-paying whole life insurance contract, you're getting uninterrupted compounding interest. When you have another account, you're not getting uninterrupted compounding interest.
So at the end of each year, that's your ending point for that year. You
Correct.
start there, guaroguared next year. You
Yep.
can't regress and go back.
Right. So take an
Okay.
example. Say you put $10,000 into a brokerage account,
Sure.
and you make 100% on your money. You're at 20 grand.
Yep.
The next year you have a lousy year, you lose 50%. You're down to 10 grand. Next year you kill it. You make 100%. You're up to 20 grand. And then the next year you lose 50% and you're down to 10. So after 4 years, you're basically right where you started again. That is what happens with interrupted compound interest. You're right back at 10,000, but your average rate of return, Jared will tell you, is what? 25%.
25%. That's right.
You got the same amount of money. You lost money with inflation, but you got the same amount of money.
That's right. So in that scenario, your net zero. I mean, rate of return was 25%.
Truly.
But your net gain was zero.
Truly.
So
That's right.
what would it look like if you had?
And not only that, if it was not in a qualified plan, here's something else to think of. Those 100-year up years are taxable. So you're going to be paying tax, and you're 100% up, and next year you're going to get whacked another 50%.
That's right.
Which changes the paradigm and the numbers a little bit, but just for the sake of argument.
For argument,
yeah,
yes.
There you are.
So if you took a similar scenario and whacked that percentage rate way down, let's say you had that same $10,000, but you were going to do it in an uninterrupted compound growth, what would that look like?
Well, that's the beauty of infinite banking, Jared, because if you took 10 grand and just left, and you're going to put 10 grand in every year, but let's just, for the sake of simplicity, keep it at 10 grand for 4 years at a 4% rate of return. You're going to wind up net $11,698, which happens to be 17% more money than you would have had in your average 25% rate of return brokerage account.
That's exactly right.
Crazy.
I mean, that is the perfect description of uninterrupted compound growth and why that's so important. One of the topics we were talking about earlier that we kind of left dead in the breeze there was the grocery store topic from Nelson's beginning of his book.
Yeah.
Do you want to dive down that story and kind of shed some light to the words that he uses in the book?
Sure. Nelson in his book talks about the grocery store example where a man owns a grocery store with his wife, and his wife is not a good banker. She goes and takes her groceries, peas off the shelf,
right.
and she walks out the back door instead of walking through the front door and paying the cashier just like everybody else. The problem with that is it takes 17 sales of those same cans of peas just to break even. So it doesn't take a sophisticated mathematical degree to calculate that in time you go out of business if you keep doing that. So the idea with infinite banking is you want to be a good banker. You're going to do the same thing or better than your commercial bank is going to do. So you're going to walk through the front door. When you take money out of your contract, you want to absolutely put that money back. Why? Because it's going to accelerate the growth of your contract, and it's also going to make money available for you later on for the next contingency. So instead of paying 12% for a personal loan from a bank, you can pull those funds for 5%. See, it's not about the rate of return, it's the volume of interest on the money that you're using. Money must flow. So put that money in a place where you can access it and prevent yourself from being forced to go borrow money at much higher interest rates from other entities that you do not participate in the benefits of.
The other thing on that same story is, you mentioned that the missus would walk out the back door with the peas, not paying them, essentially stealing the peas, not paying for them. And now you've got to turn that product over 17 times in order to just break even.
Exactly right.
That doesn't mention some of the other residuals that would happen from that too, which is what happens when your employees and the other folks see the missus walk out the back door with the peas. You think they're going to start stealing as well? And now one more theft added to the charge just continues like a cancer. So the big deal here is you want to be an honest banker. You're going to grow these policies to considerable amounts of cash value or equity in your death benefit. And what you do with those funds literally is an infinite of options. But when you borrow the insurance company's money and put that to use, be an honest banker. Have a plan to pay that back.
Exactly right.
Yep.
You can't walk into something like this with the idea that, well, I'll put the money here, I'll take out a maximum policy loan, which there's nothing wrong with doing it, and then leaving it. You don't want to do that because you're sacrificing the model that you built, the engine that you've just put in place to take care of your capital. You got to treat it with respect. You got to respect your own money.
That does a perfect job of describing this podcast, John. We're talking about a podcast that's creating tailwinds, right? When you build these policies, they take a little while to get up and running. Average time is probably 6 to 8 years. Nelson says 10 before you truly have met, the amount of dollars that you have access to or the amount of dollars that you've put into the plan. it's like starting a new business, right? It's also kind of like climbing an aircraft out on climb. It's sucking the most gas when it's right off takeoff, rolling down the runway. It's using the absolute maximum fuel flow at that point, right? And then we're pitched up. We're not going that fast across the ground in our climb up to get to cruise. Still heavy, still burning a ton of fuel.
Yeah.
And then when we get to the top of climb, that's almost the relevancy of that's your 7-year mark on your IBC whole life dividend paying policy that you set up now to let's hop behind some tailwinds. Let's watch this engine work. Let's see what it can do, literally with infinite possibilities. And it takes a while to get that up and running. But once you're there, then it turns into that wide body aircraft that's flying for 13 hours. The longer that it can fly, the better efficient that it is.
I think that's a great analysis, Jared. And just for the non-pilot audience that might be listening in, when Jared's talking about a tailwind, why it's so important in aviation is, now Jared, you're moving along at 500 knots in your aircraft, and you tie into a 100-knot tailwind. So now you've got a 600-knot tailwind. That's a 20% improvement.
600 knot ground speed.
Yeah,
yes.
a 20% improvement in your ground speed.
Yep.
So it impacts your time. Your time impacts the amount of fuel that you burn. It also increases the efficiency of the operation for connections. And it also means you have to carry less fuel if you plan for it, and you can put on more cargo and make more money. The same thing is true with your infinite banking contract. Don't be afraid. Nelson would talk about this all the time. Don't be afraid to fund your policy. You want
be afraid to capitalize.
Don't be afraid to capitalize, because it's not an expense. It's your money. It's just where you're keeping your money. Put that money to work for you in a place that you can access it and benefit, not the banker. He doesn't care. He's going to make money from you one way or the other. But if you have it in your own infinite banking account, it's you that capitalizes on that interest that you're not spending for the banker.
Yep. I couldn't agree with you more, John. And just to kind of put maybe a close to our spot today, when you just said, put it in your infinite banking account. Some folks that aren't as familiar with this might think that they could write a check out of that, or that you can swipe a credit card off of your infinite banking account.
Right.
Is that's not possible, right?
No, Jared, it's not. It's a manner of speaking, and I'm sure we'll do a podcast on. We'll cover all these mechanics. There's quite a bit here to cover, but just very briefly, what you're able to do in your infinite banking account is you can set up a conduit between your everyday bank account, because you're going to still keep that, and your infinite banking policy. And so all you're going to do is go online, you're going to select how much money you want, and you're going to move that money within a matter of days. It's going to show up in your account, in your regular checking account,
Yep.
And you can stroke a check from there.
That's perfect.
So, but it's a very, very simple process to set up, very simple. There's only two documents. There's money to flow in and money to flow out. You set up a document to cover your premiums, and that's how your premiums are paid. And there's a document for setting up to take loans out. Super, super simple.
It's perfect description. And I think it's so important to highlight that we're talking about a concept that is, not difficult. It's difficult to grasp because it's asking you to step outside of how you normally think about finance, how you normally think about banking. But this is not complex materials. We're not using fancy algorithms to come up with some mystic numbers that you can then access through certain portals over in overseas account. No, this is all very easy, simple concepts. But it is difficult because it's asking folks to break outside of that way that they think, the normal way that they think. Yeah. So I want to use that as an encouraging step into what someone may take from that, because that doesn't judge, that doesn't condone or uncondone.
Well, here's a little exercise that maybe some of the listeners could do. Grab your bank statement.
Yep.
Whether it's checking or savings, and if they're going to give you anything in interest income on there, take that and divide it into your average daily balance, and see what you're really getting. You're probably getting 0.0 nothing for your money. So why would you give them all of your capital for nothing when you could it's just where the money is residing. It has to reside somewhere, resting inside of your contract, and you're going to get, say, even you get 4%. Now, the money that you made inside of your checking account is taxable. You're going to even pay tax on that. Whereas if it's sitting inside your IBC account, it's not taxable. So what kind of an after-tax rate of return would you need to get 4%? It'll blow you away when you start crunching these numbers.
For sure.
And they really add up, folks.
Yeah, and one of the things you're going to get from a rebuttal on that is that folks are going to say, well, I've got a high yield money market account that's getting 4.5%. That's also still taxable, right? To highlight some of the points of what you're saying, and if that's where you store some of the funds and it's allowed to grow there, it's easy access and it's getting the 4% that you were talking about. But what is that doing for you in the
Time
system?
out. I've got something to share with you
Yes.
there. I was just doing a study on this very subject. Fidelity, one of the largest 401k custodians out there, their government securities fund. That's where a lot of people. I'm going to cash. I'm nervous about the market. I'm going to cash. So they put it into the government securities fund. The government securities fund has an NAV, a net asset value of $1 of one. So they have come out not long ago, a few years back, when we had this last financial meltdown, and they said we can no longer guarantee that. I did a piece on this, and so you are invested in things in that account which are government securities instruments, which could produce a loss. So you could find yourself with an NAV on your account. Say you got $10,000, and the NAV is now 9.96. It's now 1. So your $10,000 that you thought was safe in cash is now worth $9,600. Challenge me on this, folks. Go out there and look at these accounts and read about the vulnerabilities to the market and the risk of your capital inside these accounts. Inside an infinite banking account, inside of an insurance contract, that is not the case. It's a 1-for-1. It's 100% backed.
I love it. That's a perfect description, John. Well, let's put a close on our mark here today. We've been through a little bit of kind of, we call it chapter 1, or the beginning parts of becoming your own banker. We talked a little bit about the pool of money, also some of the benefits of uninterrupted compound growth, what the grocery store looks like, why we don't want to steal the peas. Again, you're going to notice some of these concepts show up over and over again in the discussion of IBC, in how we want to manage and how we want to be good stewards of these accounts that we create. John, how else would you wrap it up?
I would just like to thank our audience. Thank you for spending some time with Jared and I. We appreciate your time being here. We'd welcome your comments. We'll make sure we have a link at the bottom of the podcast for you to do that. If you have any questions whatsoever, there's never any sort of fee or commitment with us whatsoever. We view ourselves very much as educators in this space, but we would love to hear from you. Please follow us on Facebook. Please follow us on social media, and we'll have those links at the bottom. Go to our website, and we'd be happy to talk with you and field your questions.
Perfect. That's all for today. Thanks, John.
All right. Thank you. Thank you, Jared.
Cheers.
Have a wonderful day.